the Bank of Japan adjusts its interest rate, and within seconds, the value of the yen shifts against the dollar. That single localized decision immediately impacts the price of imported electronics in Europe and the purchasing power of businesses in the Americas. This continuous global exchange forms the foreign exchange, or Forex market. The Bank for International Settlements tracks this volume, and in 2022, they recorded a daily trading turnover of $7.5 trillion. For a retail investor looking at this arena for the first time, the entry points are obscured by a dense layer of terminology. Words like pips, lots, leverage, and margin create a steep initial learning curve. But beneath that vocabulary, currency trading operates on a strict set of mechanical rules. You enter a position based on defined parameters, manage your risk using automated orders, and measure your outcomes in standardized units. Mastering these core mechanics gives you the ability to isolate specific global price movements and structure them into a repeatable mathematical process. Every Forex transaction relies on a single comparison. You are assessing the current value of one currency against the future probability of another. This is why currencies are traded in pairs, such as the euro against the US dollar. The first symbol is your base currency, and the second is your quote currency. The numerical quote attached to this pair serves a specific function. If EUR/USD is listed at 1.0850, it takes exactly 1.0850 US dollars to purchase a single euro. When you look closely at your broker's platform, you will see two slightly different numbers, a bid price to sell and an ask price to buy. The microscopic gap between those two numbers is the spread, which acts as the broker's transaction fee. Recognizing this quote structure and factoring in the cost of the spread is the baseline requirement before committing any capital to a position. Once you are in a trade, you need a standard way to track performance that goes beyond simply watching a fluctuating account balance. We measure these price fluctuations in pips. For most major currency pairs, a pip is the smallest unit of movement, located specifically at the fourth decimal place of the quote. A single pip is just a tiny fraction of a cent. To give it actual financial weight, traders bundle currency units together into standardized batches called lots. Your lot size dictates the exact dollar value of every pip. If the market moves 50 pips in your favor, a micro lot makes you $5. A mini lot turns that same move into $50. And with a standard lot of 100,000 units, those 50 pips generate $500. Combining pips and lots allows you to calculate your precise monetary exposure, letting you define your total potential profit or loss before you even click the buy button. To trade a standard lot requires $100,000 in capital. Most independent traders do not keep that amount sitting idle in a brokerage account. Brokers provide a mechanical workaround called leverage. A 100-to-1 ratio lets you control a $100,000 position with just $1,000. This amplifies every pip movement, but the math works both ways. A minor swing against your position depletes your capital just as rapidly. To hold this amplified position open, your broker will lock up a portion of your funds. This good faith deposit is called margin. If your losses eat through your available balance, the broker issues a margin call and automatically closes your trade. When deploying this capital, liquidity is essential. Peak global trade volume occurs during the overlap of the London and New York sessions, roughly between 8 a.m. and 12 p.m. Eastern Time. By utilizing leverage specifically during these highly liquid hours, a retail trader gains access to institutional-level market movements, as long as they have a system to contain the associated risks. Unpredictable volatility will hit your account. Long-term survival requires setting mechanical boundaries that execute automatically when a trade goes wrong. A stop-loss order is an automated emergency exit. Hitting this predefined limit closes the trade, ensuring you never risk more than 2% of your equity. Conversely, a take-profit order secures capital, automatically closing the position at a specific target before the market can reverse. By setting these boundaries, you control the math. If you risk $1 to make 3, a 1-to-3 risk-reward ratio guarantees profitability, even if the majority of your individual trades are incorrect. These hard stops protect your portfolio from severe external shocks, like unexpected employment reports or sudden interest rate adjustments from central banks. Trading is the disciplined execution of these risk parameters. You analyze the economic data, set your exposure, place your automated orders, and let the probabilities play out. To start building these habits without risking actual capital, open a free demo account with FXNX and practice executing your trades using live market data.